Is this stock at its cheapest at the moment? Can it get cheaper? What are the 12 things that Wall Street don't want you to know? Number one, you have to buy stock at their discount. Like, always buy companies at their discount. The same mindset you have when you go to Amazon online or eBay and you're looking for the best deals, or you're saying you go to the market and you're seeing sales on the clothes and they're putting 12% off, 35% off, some 5% off. That's the mindset you want to have when it comes to stock. Is this stock at its cheapest at the moment? Can it get cheaper? This is the mindset you want to have. Can I get this stock at 35% off? What's the highest level this stock price has been? What's the level right now? Has it come down a little bit? I'm at a point where I feel like it's safe for me to come in. So let's go to number two. Number two will be stick to businesses you understand. You're a pharmaceutical guy, you're a health guy, you should look at most likely stock in the health sector because you understand how they work and how you can make profit from it, and the companies that are doing well and the companies that are needed. If you're a tech guy, fine. It's also good that you can start looking at stock that you understand in the tech sector. It's not every tech sector you might likely understand. But look at where do you have your strength in, which companies you usually follow, which company do you learn about, what interests you. These are kind of stock that will give you a guidance. But if you have interest in that company or what they do, or in a particular area of your life, it means you likely have a more research strength in that area. So it's always good that you invest in businesses that you understand. You don't want to just invest in any business. Someone say, please just invest in this and you get your money. It might be too risky. To be on a safe bet, you always want to stick to business that you understand. So let's go to number three. Number three will be competitive advantage. Now, what do I mean by competitive advantage? You want to invest in companies or stock that are highly, very competitive in the market. Like, you want to ask yourself, who can take away Coca-Cola, for example, out of the market? That's the mindset you want to have when it comes to stock picking. Can I say Amazon, how strong are they in the market? How strong is Facebook? Can a company easily beat Facebook out of the market? That's Meta for it right now. Can a company easily take out maybe Nvidia? These are things that you want to ask yourself before you start to pick a stock. What are their competitive advantage? Who are their rivals? What's the advantage they have over other companies? That's what you want to look at, because the likely that each company has a very strong competitive advantage means that company is likely going to stay for a long time and you end up not losing your money. So number four will be looking at fundamental data. So you have to check your fundamental data. What are the data saying about that stock? You just want to just pick any stock randomly. You want to look at the books, you want to look at what the fundamentals are saying about the company. Are they progressing? Are they regressing? Are they growing too high? Are they opening more markets? These are what you have to look out for. What is their last report saying? What are their quarterly reports saying? These are things you want to look at the direction of the company. Who are the directors of this company? What are their profiles saying about them on their Facebook page, their Instagram page? What they tweet about? What's their interest like? These are things that will guide you to have a direction as to how that stock would definitely go in the future. Number five will be diversification. Why am I advising you to diversify? Just like every other thing, you don't want to put your eggs in one basket, right? So when it comes to stock picking too, you want to diversify a little bit. You have some tech stock, have some health stock, have some utility stock. You don't just want to just be in one direction, because if everything is to go loose in a particular sector, you would definitely crash. But if at the end of the day you have stock in other sector or in other region, for example, because for example you could buy more stock in the US. What about stock in India that's emerging right now? This could save you at some point. So you want to make sure you have that balance. You could even have stock in Europe, in any other place, but you want to make sure that you are quite diversified internationally and in terms of the sector of the stock. So number six will be that you look at the financial statements of companies before you buy their stock. You just, like I said, you just don't want to randomly pick a stock. What is the financial statement saying? These are very important. Are they borrowing too much? The free cash flow, which is very, very important. You have to look at how much cash does the company have after their expenses, how much money they have to give out or invest more if they keep spending the way they are spending. You want to look at the free cash flow. You want to look at their debt ratio. to actually know what you're doing. The financial book and statement are very, very important. You have to look at even the book value, although sometimes this can be manipulated, but at least in some countries like the US, for example, it's still very quite difficult for companies to manipulate their financial books. But regardless, if you still are able to get into detail as to know what financials are saying, to still give you a guide to know if you're making the right decision in buying that stock or not. Now, number 7, which I said is very, very key and important in all of this, is the dollar average method. So what's the dollar average method? The dollar average method simply means that at every point in time you want to buy low or high, but you've expand your risks by saying, okay, fine, I have $1,200, for example. Instead of me just buying, let me just use Coca-Cola for example. Instead of me just buying Coca-Cola with my entire money, 1,200 at a particular day, I will say no. On the 15th of every month, I'll be putting $100 into Coca-Cola. So at the end of the day, what happens is you just put on the 15th of January, 15th of February, 15th of March, 15th of April, you're going to put in the $100 in between. Now this helps you average your risks, right? Because at the end of the day, you've expanded your risks for 1 year, which means that you naturally buy in the highs and in the lows. So this helps you avoid a scenario whereby you are caught in the middle of a dip. So it means that you would have bought in the highs and in the lows, which at the end of the day helps you average your investment because you have spanned your risks over that year and not just gone fully into it at the beginning. So this is very important. We'll go into detail on the dollar averaging method in a different video. But let's keep going. We have number 8. Be very conservative. Yeah, you have to be very conservative. If you want to invest in the stock market, you must have a conservative mindset. You must be able to look into the papers, read, check, ask questions, research, ask financial advisors. Don't just take your money and just throw into any stock. Have the conservative mindset. Be very critical about it and say, okay, fine. What's special about this stock? What are they doing that's exceptional? What's this company doing that we've not seen before? These are questions that you want to ask yourself. Why would I have to put my money in this stock? What's it likely I can make my money back from this stock? Even everybody is putting their money in and the stock is growing quickly and everybody's rushing and the fear of missing out is there pushing you. A carpet swipe is just what happens where you think you are being smart because the company price is going really high and you just rushing because of the fear of missing out, you quickly rushing and buy. But what happens at the end of the day? There's a carpet pull, and when the carpet pull happens, what happens? You are the top there and you are the loser. Sorry to say it, you have lost your money. Otilo, like they'll say from where I come from anyway. So you don't want to be stuck in a place where there's a carpet pull out and you end up losing your money, right? We don't want that for you. So you have to make sure you have a conservative mindset. You make a lot of research before you invest your money. So number 9 would be that you use stock screeners to do your research. Like sometimes you can use the Yahoo Finance website or their app where you can get like a free version of stock screeners into regions, where you get stock divided into sectors, market cap, yield, dividend yield, and the rest. So this helps you reduce your time of research and you don't end up spending so much time being everywhere. You just spend time on, if you're looking for small market cap, you just search for small market cap. If you're looking for large market cap companies, you just go straight to it and see what is happening behind the hoods. So this will help you save time in your stock picking. So number 10 is zero emotion. When it comes to stock market, you don't want to be emotional about it. You don't want to say, oh, my friends are buying, so I should just buy this stock. That is a wrong approach to stock picking. You don't want to say, oh, everybody seems to be buying this stock. I've been there before. Sometimes I still suffer from it, but constantly I tell myself not to be moved. One of the things about being conservative in stock market is that you will lose some great opportunities. That's the honest truth. You will lose some great opportunities. But the overall compounding interest for you is that you end up not losing so much. Because if you keep following all the flow because you want to gain every time, you would end up losing a huge sum that would counter that whatever you've been able to make in the past, right? So you want to make sure that at every point in time you are making more profit. The idea here is you don't want to lose money. That should be your first mindset. You don't want to lose money. As long as you don't want to lose money, it's not about the fact that you don't want to gain, but the first thing is you don't want to lose money, because someone can gain £1,000 this year and next year they're losing £2,000. You don't want to be that guy. Someone gaining £500 this year and the next year is gaining another £500, it's better than the guy that gained £2,000 and lost £3,000 the next year. So your goal should always be, I don't want to lose money. So number 11 should be study the market. Yeah. So when I say study the market, like every other thing, you have to give it your time, right? When it comes to stock market, you have to make your research, make your analysis, ask questions, read books, watch YouTube videos like this where you get tips and ideas. You have to study constantly about the stock. And before you buy any from any company, study. Like study the stock, study the financial book. Be that guy that want to actually get out and is on their case. That is the way you should monitor your stock, because you're investing money, dedicate time, and to pay off in the money that you don't lose, and also help you to make more money. So number 12, which is our final one, will be keep cash ahead. Yeah, this is very important because most times people just carry their entire money and just throw into the stock market at different points in time. Oh, this stock is going very high, and they just throw their money in. You don't want to be that guy that ever loses money, like I've said before. So always keep cash ahead. There will always be a lot of buying opportunities. Stock market is there for life, so there's nothing to lose. If people are making so much money, let them make. Don't feel threatened. Oh, I'm missing out of this. You're not missing out of anything. Stock market is there for life. So why are you worried? Why are you stressed? Don't get stressed. Just keep your money. When that buying opportunity time comes, you go into the market and you buy. So when people are running out of the market, that is some of the times you want to really go in, because the idea about making profit in stock market is that you buy low and sell high, right? So that's the mindset you want to have. So if you keep your cash down, and when there's a crash or something in the market, you can quickly go in and buy based on your research. Obviously, you've done your full research before you buy, so you're not worried as to if you're buying a product that is crashed. And secondly, again, this will also make you buy that company at a very good discount rate, like I've mentioned before. And after going to the financial statement, you already know that the fundamentals are good. So if a bad news is happening generally and making the stock market shrink, you won't be worried, because you know you're buying at the right time, because the market is going to expand back in a good season and you'll make more profit that way. So you want to keep cash aside, because there's nothing as terrible as having a good buying opportunity and you don't have the cash available. So you always want to keep your cash ahead, So for those that have stick to the end, I have some bonus for you, right? But before I do that, please do subscribe down below. We have more interesting videos coming through. Like I said, I'm going to explain the dollar averaging method in more detail in the next video. And the bonus for this one will be that also note that, one, you want to do what they call value investing, to always make sure that the intrinsic value of a company is what you're looking out for. You just don't invest without knowing what is the actual value of this company. Number 2 will be that you invest in dividend stock. So what do I mean by dividend stock? Dividend stock are stock that pays you dividend on your stock. So you want to be involved in such kind of stocks because they help to balance your portfolio, And the last tip I'll be giving you for this video will be that invest in ETFs like the S&P 500. Research has shown that the S&P 500 is hardly beatable by most investors. So it's just advisable that you just be in the S&P 500. If you're not too familiar with stock and risk taking, please make sure you just go straight to maybe like something like the S&P 500. ETFs like that will help you balance your portfolio, because the S&P 500 over time has been known to at least get an average of at least 10% yearly, which sometimes could be more because of the loss and profits. We're going to be an average of 10% in 10 years, according to the statistic, at least for the last 10 years, it's an average of 10%. So, which means that on the average, if you're investing in the S&P 500, you will likely not lose your money in the next 10 years. That's a better and smarter way to invest and not take all the risks on yourself by just picking a stock if you know you're not able to do enough research for that stock. So guys, I hope you enjoyed this one. See you on the next one. Peace out.